I think the FTSE 100 is an absolute load of rubbish, and here's why, in my opinion, you shouldn't buy it. And if you like this video, please drop one of these to help beat that YouTube algorithm, as it is much appreciated. Now, I must admit, as being an individual stock investor, index funds are something that I do not favour that much. However, over the time of picking individual stocks, I've now started to understand and really get behind the motions that a lot of these investors do, where instead of trying to beat the markets, they buy the markets. And in particular, I've been looking a lot at index funds in particular, and I usually just clump them together, especially the common indices. Now, I'm talking FTSE 100, I'm talking S&P 500, I'm talking the Nasdaq 100, and obviously the Dow Jones Industrial Average. I'd be looking at these thinking, well, they're all the same. They've just got a different bunch of companies. However, I didn't realize for a long time that I was actually, in fact, wrong. And yes, for a long time, I do think the FTSE 100 is a very bad index. And it is probably the worst of them all. Now, you look at the year-to-date performance and you'd go, well, the dark blue line there is the FTSE 100. It's actually holding its value and it's up 0.23%, whereas the S&P 500 and the Nasdaq 100 have dropped considerably over this time frame. You scale it back a year, and even then, the FTSE 100 is still pulling ahead with a nice, decent return of about 7%, and those indices are down. However, you go over periods of longer time than that, you'll see that the FTSE 100, whilst yes, it's preserved its value just over 5 years, not including dividend income, the Nasdaq and the S&P 500 have massively outperformed it. And now this isn't a case of really beating on the FTSE 100 for being worse than its constituents, but there's definitely some good reasons for it. And it's not that the UK economy is weaker, because quite frankly, yes, you can look at UK GDP growth over the last 10 years and you'll see it's only had about 1 to 2.5%, and it's pretty weak and pretty inconsistent, or consistent, sorry. And in the US, they've had higher amounts, so they've had about 2 to 3%, really pushing a lot faster and further than the FTSE 100. However, it's also important to mention here that whilst the FTSE 100 is a poor representation of the UK economy. As a matter of fact, 76% of the FTSE 100 companies in this are listed have revenue outside of the UK. This means that yes, the FTSE 100 is globally diverse. And no, the problem with the FTSE 100 is not that it's exposed to the UK and not that it has globally diverse investments. It's a matter of fact of how the companies stay in the index. Now, when you read into the FTSE 100, you'll notice that it is the largest stocks on the London Stock Exchange by market capitalization, the largest 100. Now, I always assumed this was how all indexes work, or indices work, but I realized that I was incredibly wrong. As a matter of fact, other indices do share similar traits to this, like their free floating weighting mechanisms in order to justify which companies have the highest market capitalization and therefore the highest weighting in these funds. However, it goes deeper than this. And whilst the FTSE 100, as I said, is just that weighted amount of the largest stocks, this means the big, the old, the beasts that have lasted 200-300 years that might not be doing so well nowadays, as long as they're still large in size, they're likely still going to be in the FTSE 100. And a quick look at the largest companies in the FTSE 100 would very quickly tell you that. You can see the names of Shell, you can see Diageo, which obviously was formed through the merger of Guinness and something else a few decades ago now. You've got the London Stock Exchange Group themselves, Lloyds Banking Group. You've got a lot of old names. I mean, need I go on to Aviva, for instance, where they go back many, many years. And the problem with this is because it's weighted to the highest market capitalization companies, it means there is a large disadvantage for any new companies that are up and coming that don't really get a chance here. And this is where I really like the S&P 500. The S&P 500 has a good few requisites or prerequisites before it can be listed. Firstly, it's got to have a minimum market cap of a certain size, which as of March 2022, the S&P 500 had a minimum market cap of $14.6 billion. Now, in America, where there are plenty of companies with plenty of large evaluations, this is a fine mechanism for them to really prerequisite before adding to the S&P 500. However, in the UK, and I couldn't tell you the exact number of companies listed on the London Stock Exchange, but I'm sure I could Google it. Realistically, there are barely any that have above that kind of a minimum market cap, whereas I could scroll down to nearly, I'm already about halfway through the FTSE 100 and we've run out of options. Now, obviously, this would be based on a median. You would look for a certain minimum market cap that you would deem reasonable for the top 100 companies, and that would be a fairer mechanism. However, this isn't the main factor I'm looking at. They talk about the value of its market capitalization traded annually. Fine, same as the FTSE 100. The main thing here really is that it has a positive sum of the previous 4 quarters of earnings as well as the most recent quarter, meaning companies that join the S&P 500 were at some point profitable. Whereas they might not be at the moment, they were. And that is a very key sign of being a prerequisite to join. Whereas the FTSE 100, it's straight up just market capitalization. Yes, they do the free floated weight capitalization here, but it's just size. So therefore, you could have a massive company that is losing a significant amount of money, and it will have a large weighting on the FTSE 100 index, which gives you, the investor, a significant disadvantage. Now, it's no surprise that over this time period, the FTSE 100 has underperformed massively. You go back to the inception of this, which it will go back to 1984 for the FTSE 100. It's a bit unfair that it's tracking back before that. It's significantly underperformed during this entire time period. The FTSE 100 has no advantage over that of the S&P 500. Yes, before, I believe the S&P 500 was the largest 500 companies in the US, whereas that's not the case. There's a few more prerequisites that we've mentioned, making it a fairer group of companies that are likely profitable and therefore likely delivering value upon their own companies, and overall in the size of the total index likely generating a return for shareholders, whereas the FTSE 100 really doesn't offer much of that in the way of a dividend yield if the company is making profits. Now, the FTSE 100 does not to say that the companies aren't making money, but a lot of their money goes into paying out dividends, and then yes, they do have high cash flows. I'm talking Shell, I'm talking Diageo, I'm talking Unilever. They have very high levels of cash flow, including the old world banks and the tobacco companies, but they just don't have that much growth. And when you join the S&P 500, there are companies that at least have a little bit more growth and a fairer weighting. Yes, you've got the likes of, and let's look at the heat map here. Yes, you've got the likes of Amazon, Microsoft, Google, Apple, all taking up a huge weighting in the S&P 500, but at least these companies are really delivering value, and the reason they've got to this position is because they have grown. Yes, it is weighted upon market capitalization, the same as the FTSE 100, but there is a chance here where these other companies can take it up, and they are continually earning money. Whereas you look at the top companies in the FTSE 100, you've got Shell. Yes, okay, they're probably not going anywhere time soon, but that's exactly the point. They're hardly going to grow that fast over the next 10, 15 years either. And from this, what I've discovered is that, well, effectively, a lot of these companies here, let's just look at, let's say, Bank of America, BAC, just to check. Let's see if they're a profitable company, just for example. We're looking at Simply Wall Street here. If you'd like to sign up, there's a link in the description down below. I mean, it is a bank. It's likely profitable, and it is by a considerable margin. I mean, they are making about 32.1% per their revenue in profit margins, which is a very promising figure indeed. And what I've taken away from this is that I'm actually going to have some investments in an S&P 500 fund. I always used to believe, yes, you can have a global, all-world diversified index fund that tracks the global economy. However, I like the filtration systems that the S&P 500 takes into place. It's quite like my own system in where I try to filter out a lot of the rubbish companies and only invest in the companies that I think are my personal best ideas that are going to generate long-term value upon their own business, which would subsequently over time be reflected in the fair value of the share price. And therefore, holding some of your equity in the S&P 500, in my opinion, is such a great way to grow your capital over time. No, you won't get rich quick, but you'll certainly get rich slow. Provided you save and invest a high enough amount each time, over time you will likely become a millionaire, in my opinion. Therefore, the FTSE 100 is not something to consider investing in unless you are a trader or a swing trader. Sure, you could take some dividend yield from it, but realistically, I think the returns are just going to be better overseas in an index that really filtrates a little bit better than just by market capitalization. Have a fantastic day.